Hey everyone, welcome back to the channel. Today we're demystifying a financial concept that sounds complex but is absolutely critical for anyone in multifamily real estate, the yield curve. Understanding it is like having a crystal ball for interest rates and economic health, which impacts both operators and limited partners. Let's break it down. So, what exactly is a yield curve? At its simplest, a yield curve is a graph that plots the yields, or interest rates, of fixed income securities, like US Treasury bonds, across different maturities. Think of it as showing you the cost of borrowing money for different lengths of time. On the graph, the vertical axis represents the interest rate, or yield, and the horizontal axis represents the time to maturity, from short-term like 3 months to long-term like 30 years. Typically, longer-term bonds have higher yields because investors demand more compensation for tying up their money for a longer period due to inflation risk and uncertainty. This creates what's called a normal yield curve, sloping gently upwards. But yield curves aren't always normal. There are two other key shapes that send important signals. One, flat yield curve. This is when short-term and long-term yields are very similar. It often signals economic uncertainty or a transition period. Two, inverted yield curve. This is the big one that gets economists and investors nervous. It's when short-term yields are higher than long-term yields. Historically, an inverted yield curve has been a surprisingly reliable predictor of an upcoming economic recession. Why? Because it suggests that investors expect future economic weakness, which would lead to lower interest rates down the road. So why is understanding the yield curve so critical for both multifamily operators and limited partners, LPs? For multifamily operators, financing costs. Your debt is the biggest expense for many deals. A normal curve means you might pay more for longer-term fixed-rate debt, which provides stability. A flat or inverted curve could impact your ability to get favorable long-term financing or signal an impending need to refinance at higher rates if you have floating rate debt. Refinancing strategy. If the curve suggests rising rates, you might want to lock in long-term debt sooner. If an inversion signals a recession and potential future rate cuts, you might consider shorter-term debt to refinance later at lower rates. Cap rate implications. Yield curves influence cap rates. When long-term rates rise, cap rates often expand, meaning property values might go down, making it harder to sell at your projected price. An inversion can signal weaker buyer demand in the future. Tenant demand. An inverted curve's recession signal means potential job losses and reduced household income, directly impacting your ability to raise rents or even maintain occupancy. Host for limited partners, LPs. Risk assessment. The yield curve is a major macroeconomic indicator. It helps you assess the overall economic risk of a proposed deal. Is the operator underwriting aggressive rent growth or value add strategies right before a potential recession, signaled by an inverted curve? Operator due diligence. You can use the yield curve as a framework to question your operators. How are they mitigating interest rate risk? What's their plan if the economy slows down? Are their exit cap rate assumptions realistic if rates are projected to rise significantly? Investment timing. It helps you understand if it's a good time to deploy capital. A deeply inverted curve might suggest caution, while a steepening normal curve could indicate improving economic conditions. The yield curve isn't just an abstract economic graph, it's a powerful tool that offers insights into the future of interest rates and the broader economy, directly impacting your multifamily investments. Pay attention to it. If you found this explanation helpful, please give it a thumbs up, subscribe for more real estate insights, and share your thoughts in the comments below. See you next time.